The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A handshake on a trade deal and a stare down over the budget. Live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Who says nothing happens in a holiday-shortened week, right?
Hey, the holiday in here yet, Scarlett.
There you go. All right, let's take a look at how markets are faring right now. You have the S&P 500 resuming its rally at a record high after President Trump announced that trade deal with Vietnam. Small caps outperforming the big caps for a second day, and in fact, that has been the trend over the past month. Yields moving up across the curve, especially at the long end. The 10-year now just under 4.29%, and the pound, a big loser in today's trade. The Prime Minister Keir Starmer failing to fully back his Chancellor of the Exchequer, who's got some credibility with the bond market. A lot of investors worry that there might be a replacement who will increase borrowing and increase spending. Romaine?
Back here in the U.S., 622 and change right now on S&P 500, a record high on the back of optimism on trade. Investors shrugging off the prospect for any real drama around that July 9th tariff deadline. In fact, the president himself out with a social media post saying he's brokered a trade commitment with Vietnam. And that news, believe it or not, did take the S&P from flat on the day to back to record territory. Tariff-exposed stocks like Nike, Wayfair, and Shark Ninja leading that corner of the rally.
The consensus view among almost everybody was that tariffs would start to impact the data in March. It didn't happen in March, it didn't happen in April, it didn't happen in May.
And the trade developments offsetting some concern about Trump's deficit-widening budget bill, as well as concern about new economic data showing a soft labor market. Now, while equity investors appear to be looking past that, bond traders aren't. You saw 30-year treasuries selling off, pushing yields up the most in about a month, and that's possibly taking a cue from the plunge that we saw over in the UK as the Brits there grapple with their own fiscal issues. And that leaves bond traders, at least those here in the U.S., in a bit of a bind ahead of tomorrow's June employment report, which is expected to show the slowest growth in 4 months. Traders who built up long treasury positions in anticipation of falling rates are now counting on expectation becoming reality with that report. But they may find themselves between a rock and a hard place on yields if economic conditions put downward pressure on rates at the same time, Scarlett, as the budget bill puts upward pressure.
All right, let's continue to talk about economic conditions, because despite Trump's tariffs, inflation has yet to see a real pickup. We had a 2.7% print in the first quarter in core PCE and a projected read of about 2.5% for the second quarter, that April through June period. But that could change in the next few months. You could see here Fed Chair Jay Powell saying policymakers anticipate seeing the impact of tariffs later this summer. That is reflected in these economists' estimates as well. They forecast core PCE, which is, of course, the Fed's preferred inflation gauge, to rise and stay above 3% all the way through the middle of next year, which would get in the way of any potential rate cuts. Romaine?
And that leaves a lot of questions going forward as we kick you off to the close here on this Wednesday afternoon on the holiday-shortened week. Zachary Griffiths joins us right now to kick us off to the close, head of IG and macro strategy at CreditSights. And Zach, I do want to get your thoughts here on how bond traders sort of navigate competing interests when it comes to the direction of interest rates and whether there is real conviction about what direction that might be.
Romaine, it's a really tough environment, and what we've been expecting is this stagflation-like outcome in the U.S. where you have growth slowing and inflation rising, as you just saw. And I think what we've learned from the Fed over the past couple quarters, looking at the summary of economic projections, is right now they are more concerned about the inflation side. While the median dots haven't shifted materially over the past 6 months or so, the average dot has shifted higher in each of the last two summary of economic projections for 2025 and 2026. So to us, the sensitivity on the Fed is on inflation. And while we haven't seen it in the numbers yet, we are expecting to see it perhaps as soon as the CPI report in the next couple weeks.
That, of course, is going to play out big time on the short end of the curve. On the long end of the curve, it's something also playing out. Obviously, that also has to do with inflation, but much more on fiscal issues. And I'm curious if you could kind of give us your perspective, not on what U.S. bond investors are expecting, but what foreign investors in U.S. Treasuries are expecting. Are they really pulling back? Are they worried right now, Zach?
It's interesting, Romaine. I just got back from a trip to Taipei and Hong Kong, and while the number one topic of discussion was the U.S. deficit, what it means for Treasuries going forward, we haven't heard a ton of reallocation away from U.S. dollar assets broadly, or even a huge boost to hedging ratios. And so to me, it's almost consistent with the soft data versus hard data conundrum we have here in the US, where the soft data is very weak, but the hard data has more or less held up. And so the big point we had been making to clients is when you go back and look at throughout history what large budget deficits have meant for the curve, it's a steeper curve, and particularly in the 10s, 30s segment. And so I think there is a lot of concern. There hasn't been huge moves in terms of reallocation just yet, but I think those conversations are happening now and could have a bigger market impact in the future.
Do you think those decisions will hinge on how the big, beautiful bill gets resolved?
I think to a certain extent, investors are already pricing in the one big, beautiful bill, at least in some form, whether it be 2.8 trillion added to the deficit or 3.4. The idea is we're going to see more supply from the U.S., and there's concerns fiscally really across the globe, as you highlighted with the U.K. today. And so when I think about what that means decision-making wise, from do I buy a 10-year security now to hold for the next 10 years? Do I think yields will be lower or higher over that time frame? I'm thinking a lot harder about the prospect for yields to remain lower. And I think the budget deficit and government bond supply globally is a huge consideration. But I also think the ultimate destination of the Fed and other central banks' policy rate is a key consideration as well in terms of where inflation shakes out with this new isolationist type world that we're living in.
So, Zach, putting that all together, where do you want to be in terms of investing in fixed income?
So we've been advising clients to move up in quality and shorter in duration. And admittedly, that's been a tough trade after the worst of the volatility following Liberation Day. It seems like risk sentiment has improved despite a pretty rough geopolitical backdrop. And so when we think about how this all impacts the second half of the year, we are expecting the strong technicals that we've seen so far to give way to more fundamental concerns. If we don't see tariffs show up in consumer prices, I think we're going to see it in margin compression in earnings over the course of the next couple of weeks as we get Q2 earnings reported. And so I think that becomes a bigger driver and more of a market concern in the second half of the year. So we still like up in quality and shorter in duration in U.S. corporate credit.
I am curious, though, Zach, if there are still concerns out there about the state of the economy, global economy, to be sure, why haven't we seen maybe a little bit more activity when it comes to corporate spreads and a widening out there? Is there some balance that I'm missing?
I've been a little confused by it myself, and I think what it comes down to is there's just still a lot of liquidity in the system. When you look at money market mutual funds, we really haven't seen them drained much. And even though the Fed's been doing quantitative tightening for 3 years, we haven't seen bank reserves come down either, as a lot of that has been absorbed by the overnight reverse repo facility. And so that's another thing that we're focused on in the second half of the year. Perhaps markets that have been awash with liquidity, that starts to shift once we get past the noise from the debt ceiling and the passage of the one big beautiful bill.
Zach, got to leave it there. Zachary Griffiths, head of IG and macro strategy at CreditSights, kicking us off to the close here on this Wednesday afternoon with a focus on the record highs in the equity market and a focus on the continued creep higher in Bitcoin. A big question about whether we're on the brink of another boom in that space. A discussion up ahead with Anthony Pompliano, founder and CEO of Professional Capital Management.
Plus, Bitcoin's not the only thing rallying today. Shares of Tesla also higher following a 6-day slump in spite of a big miss on second quarter deliveries. Why investors and analysts think vehicle sales may have bottomed.
And from EVs to the future of work, a discussion about AI, how it's transforming the global workforce, and a big role over at Servicenow. A conversation with Jacqui, Canney, Chief People Officer at Servicenow. This is The Close on Bloomberg.
It turns out the crypto president's influence may be relatively narrow. Yes, President Trump's support for the industry shows up in Bitcoin's price gains, but many lesser-known altcoins have actually sustained significant losses this year. So let's bring in a key stakeholder in the industry whose Bitcoin company is now set to go public via a SPAC. Anthony Pompliano, the founder and CEO of Professional Capital Management, joins us live in studio. Great to see you.
Absolutely. Thanks for having me.
So Bitcoin and stablecoins aside, most altcoins have really struggled for relevance. They've lost more than $300 billion of market cap in value this year alone. Why do you think this is? Does this tell us more about Bitcoin's prominence or the other tokens' lack of appeal and utility?
Well, I think Bitcoin is the king of this market. It will remain the king of this market. And I think what you're seeing is very smart institutional capital allocators are coming in. They're evaluating a lot of things that are in the market, and they're choosing to put their capital in Bitcoin. Some of that is the size of Bitcoin, the history of Bitcoin, the decentralization of Bitcoin. But also, if you look around the world at government's support or regulatory clarity around this thing, Bitcoin is the thing that is the safest place for them to put their capital in terms of the crypto market. And I think that's why you see capital flowing to kind of where it's being treated best. And Bitcoin's return over the last 15 years has really kind of shown what it can do. Yeah,
first mover advantage to the core. Your ProCap BTC is pursuing a Bitcoin treasury strategy that Michael Saylor kind of invented over at Strategy. You plan to accumulate up to $1 billion of Bitcoin on your balance sheet. What kind of timeline are you looking at to achieve that?
Well, we are starting with the first billion or so. We obviously raised $750 million in equity and convert. We're merging into a SPAC that is $250 million. So that'd be the $1 billion to buy with Bitcoin. We've already purchased over 4,900 Bitcoin that we've publicly announced. And we'd like to buy as much as we possibly can. So I think that part of this is really trying to figure out creative ways to raise capital, go put it into Bitcoin. But the thought process of Bitcoin in particular is Bitcoin is the new hurdle rate for an entire generation, right? I think, our grandparents, our parents, they grew up with the S&P as the hurdle rate. That's not the hurdle rate anymore because I have an asset that is, again, my benchmark, which is Bitcoin. If I can't beat the benchmark, I have to buy it. And I think that's really what Bitcoin has become is if Bitcoin is that hurdle rate, what a ton of investors are realizing is they can't beat it. For the last 5 years or so, the compound annual growth rate is 60%, destroyed stocks. And so now we are putting together a business to say, if we can't beat Bitcoin, let's go and buy it.
That's a good point. But what about on a risk-adjusted basis? Because certainly in the early days of crypto, that was the big concern, that the returns were there, but it also came with a lot of volatility that, of course, would scare away certainly traditional investors.
Well, there's two types of investors. Yeah. There's people who run away from volatility, and there's people who run towards it. And I think that we have an entire generation of people who are running towards volatility. Frankly, most of the assets in the traditional financial system have no volatility. They have no return. What they're watching is the dollar is being debased away, and they're falling further and further behind. And so you need something that has volatility that can actually outpace that inflation, and Bitcoin has delivered that. And so I think of Bitcoin's volatility really as something that is a strength of the asset. Now, what also is interesting is if you take Bitcoin, you put it into a portfolio, what you see is a number of kind of modern portfolio theory metrics actually improve. Things like the Sharpe ratio goes up. And so what you're seeing is these institutions that have what I would consider kind of sophisticated capital allocator frameworks, they're saying, here's an asset that's asymmetric, that will improve my Sharpe ratio and change the kind of ingredients of my portfolio. I've got to put it in there.
So you're suggesting that the per unit risk on something like crypto, to a certain extent, on a relative basis, is better than stocks?
There's this famous chart online that if you go and you look at all assets on a risk-reward basis, everything is kind of correlated down in the kind of the bottom left. Bitcoin is all alone up in the top right because it has the highest risk reward.
Yeah, so I am curious though too. I mean, particularly for new folks getting this, and I get asked so many questions by friends and family who aren't in finance, and of course, there's a lot of interest in this right now, but they look at it strictly almost on a price appreciation basis. So for all the hype that we've gotten out of Washington and the support they have for the crypto industry, out of all of the corporations we've seen add this to their balance sheet, we're still kind of pinned at around $110,000 or less on Bitcoin, give or take. And I am curious as to why we haven't seen more of an upside given how much activity is out there.
Well, I think it's three things. One is it was $69,000 on November 1st last year. So we have seen upside. It's just that the expectations on the second point are, people wanted to be at 500,000 or $1 million. You see all these crazy numbers. You say, well, we're not there. So it's kind of like expectations and reality don't match. Then unhappiness enters into the market. But it has appreciated pretty significantly. And I think the other thing is that there's a lot of money pouring into these Bitcoin treasury companies. But one thing that maybe the market doesn't understand who aren't in these kind of institutional conversations is a lot of the dollars are hedged. So what is happening is institutions are putting dollars into, they're going long the stock, and then they may be shorting either a spot Bitcoin or an IBIT, a BITB, whatever it is. And so what they're really doing is they're trying to lock in exposure to the premiums for the time being. And so if every dollar that's going long is also hedged, obviously you're kind of have this delta neutral aspect where there's not going to be as much price impact. And so I think that'll change over time, but that's another reason why you're not seeing kind of this rapid appreciation in Bitcoin in the short term.
As a crypto bull, as a Bitcoin bull, what worries you the most in the coming months?
I think that there are two things that could be an issue. if the government stopped printing money, that actually could be a negative for Bitcoin. I was very bullish on the administration coming in and being able to stop spending, stop printing money. I think that they have waved the white flag, and you hear kind of a complete change in their vernacular, and they're saying, hey, we are going full hot, we're going to use growth, et cetera. And so I don't think that that's going to be a risk, but that would be a risk. Is Bitcoin really is this kind of global liquidity barometer, if you will, to borrow a term from Lynn Alden and Sam Callahan. The other thing that I think is a fairly big risk is if we do not get the central banks, that is like the last big pool of capital. Now, the nice thing is the quote-unquote risk is kind of like a fake risk, right? It just means we're not going to grow nearly as fast as everyone wants. But Bitcoin is the one asset, the bigger it gets right now, the less risky it becomes to these large capital pools. And so they are waiting. I was telling you guys earlier, the central banks are knocking on the door. They're the first one to go ahead and buy. You are going to see a domino effect very, very quickly because they understand what's happening to fiat currency. They're very involved in that. They've been buying a lot of gold, and they're saying to themselves, well, is it gold that I want to hold for the next 25, 50, 100 years, or maybe I need some Bitcoin? And there's this famous line from Satoshi Nakamoto that says, you might want to get a couple coins in case it catches on. I think central banks will be the ones to do that next.
All right, Bob, got to leave it there. Anthony Pompliano, the founder and CEO of Professional Capital Management, as the show rolls on, getting closer to those closing bells with the big eye on the big movers on the day. Tesla, a 5% pop in the stock, despite a 13% drop in its most recent quarter for vehicle deliveries. We're going to talk about investors making a big bet that Tesla's sales slump may have bottomed. That's coming up next here on The Close on Bloomberg. All right, top calls, big movers on the back of analyst recommendations. And we start off today with Adobe. Rothschild and Company Redburn downgrading the software giant to sell, slashing the price target from $420 to a street low $280. The analyst is very blunt. He says Adobe's moat is being eroded by generative AI, and in the absence of a strategic shift, free cash flow growth will continue to slow. Those shares down about 4% on the day, and one of the biggest laggards among tech stocks on the year. Next up, Crocs. Goldman initiating coverage with the sell, the only negative rating among analysts tracked by Bloomberg. The price target, a street low $88. The analysts concerned about accelerating competition and shifting consumer preferences. Those shares, though, only down by 0.1%. And last up, Carvana. Citizens raising its price target to a street high $440, maintaining an outperform, and the analysts saying that Carvana will outpace industry growth, and it's benefiting from its scale. The share is up about 1% on the day, and those are some of our top calls. Now, we do want to stay in the automotive sector and talk about Tesla. The share is recouping some of the losses from a 6-day 14% slump as investors parse the decline in the company's quarterly delivery figures, a decline that was less drastic than thought, and one being interpreted as a bottom for the EV maker's recent woes. Dan Levy joins us right now, senior equity research analyst over at Barclays. All right, Dan, I mean, we were expecting trouble in the past quarter. We got that trouble. The big question, when you look ahead to this quarter and the quarters beyond, are we still going to see a decline in sales growth?
Hi, Romaine and Scarlett. Thank you so much for having me. Look, this quarter ended up coming in ahead of our estimate and perhaps more importantly ahead of what was more depressed buy-side expectations. But the reality is when you look at the first half and even the second quarter, you still have sales that were down something in the double-digit range, low teens. And so even with a ramp in the second half, you're still going to be looking at volume for the full year potentially down double digits. And I think that tells you that there is still a volume challenge, and that's before we even get to potential risks ahead with the removal of the EV tax credit.
Well, talk a little bit about that. As the budget bill makes its way through Congress, the removal of that $7,500 credit, and the idea here that for a market that is still important to Tesla, the U.S. market, at least a third of its sales, removing that tax credit, do you think that will materially impact the number of Americans that are willing to go out and buy an EV?
Yeah, it's probably going to have a decent impact, right? When we think about Tesla, our guess is that, more than half of the U.S. sales are benefiting in some form from that U.S. tax credit. When we look at, Tesla as a whole, that means that, you're talking about 20% or more of total Tesla sales benefit from that credit. When we look at the EV market more broadly, when we think about the fact that lease penetration is in the 50-60% range, all that lease penetration is a function of the leasing loophole associated with that. So it tells you a lot of people are benefiting from that. This is why you see these exceedingly attractive deals. You can lease a Model 3 for as low as $349 a month. You really don't have many good deals like that on ICE.
Yeah.
So yeah, EVs are benefiting from it.
Well, slumping car sales, like the kinds that we just got, are going to weigh on Tesla's profits. And you could even say that the company is already losing money if it weren't for the sales of those clean air credits. How forgiving are investors going to be if Tesla prints a loss on the bottom line?
Look, I think where the multiple is tells you that we've moved past fundamentals. For the most part, this is a stock where we say fundamentals don't matter with the PE that's well into the 100+ range. But our view is fundamentals don't matter until they eventually matter. This is something that's driving earnings today and for the foreseeable future. And perhaps more importantly, this is what's funding all of the efforts on AV, humanoid robots, et cetera. So it is important in that regard.
Does Elon Musk continue to capture investors' attention with talk of the robo-taxi and AV and all the humanoid robot, all of that? I mean, what does he need to do to kind of keep investors committed to that narrative?
Narrative. It's 100% about keeping that narrative front and center, keeping the dream alive, and showing that they're progressing on AV, they're progressing on humanoid robots. This is a stock that clearly, if it's in the $1 trillion valuation, if we look at the best automaker out there, that's Toyota at $300 billion. Even if Tesla's automotive business is worth $300 billion, tells you all the other stuff is worth $700 billion of value. So you've got to keep the narrative going on those growth endeavors, AV and humanoid robots, amongst other things.
All right, Dan, I've got to leave it there. Dan Levy, Senior Equity Research Analyst over at Barclays. A closer look at those delivery numbers that we got out of Tesla, Scarlett, and, of course, the market reaction for a stock that, of course, it had been in a pretty deep funk, getting a modest bid. But it also raises a question just about the appetite for EVs. We had news yesterday when Ford made their delivery numbers, which overall were good for ICE. But in the EV segment, there was basically nothing going on there. There were just headlines about BYD, which is having its moment in the sun, apparently pausing some production, the build out of production in Mexico because of tariffs. So there's a lot of questions about what EV production is going to look like, and more importantly, what demand is going to look like.
Well, and what demand is going to look like for $50,000, $60,000 cars right now, because a new car is going to cost about that amount. And we know investors and we know consumers are kind of like taking a much more careful look at how they're spending. Yeah, and it gets to the question, too, about infrastructure as well, because remember, that was sort of the big bugaboo for years was where do you charge these things if you don't have your own house to charge it? And there was a build out of infrastructure. We've seen money removed from that out of the federal government. So it raises a lot of questions about what the ecosystem for EVs is. Yeah, certainly compared to a place like China, which has gone all in. All right, coming up, we're going to speak to Ralf Reichert. He is the CEO of Esports World Cup Foundation before the tournament kicks off next week in Riyadh. Have you played esports before? I have. And how do you do? Not well. You're Gen X, that's why. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick. And I'm Scarlett Fu. It's a holiday-shortened week, Romaine. I know a lot of people are getting ready to spend the long weekend training for marathons or triathlons. Are you? That's how you're spending it? No, I'm not, but I know a lot of people who are. I was going to spend it like on the couch doing nothing. But yes, for people more ambitious than us, yes, a lot of people will be doing that. But for those people that aren't out there training, some of us like to watch other people do heavy physical activity. Yeah, we could definitely do that. But, I think about Saudi Arabia and its involvement in all of these spectator sports, as well as those that require you to get up and move. For instance, the Sovereign Wealth Fund has just invested in the Professional Triathletes Organization, which organizes the Michael Moritz-backed T100 Triathlon World Tour, along with like spectator sports like F1 and boxing and other things. Yeah, and they've gotten into that. You've seen, obviously the Saudis have entered into MMA, professional boxing, F1. European soccer. Of course, they have the World Cup, what is it, in 2034, on top of that, and a lot of other sports as well. And it's raising a lot of questions about just how far they can go with this. And you know where they've gone? Esports, Scarlett.
Esports,
it's called video
that's right.
gaming,
Yeah,
which is a real sport now. Which you can play sitting down.
I know. Well, our kids know this. We're not so much convinced of it, but we cling to our old ways. Kicking off in Riyadh next week, Saudi Arabia is going to be hosting the 2025 Esports World Cup. This year, you've got more than 2,000 players expected to compete for a piece of the $70 million prize pool. So I am pleased to say that the man in charge of that event joins us now. Ralf Reichert is CEO of the Esports World Cup Foundation. Ralf, thank you so much for joining us.
Thank you for having me.
So esports has actually been around since the 1970s, but it really took off in the 1990s. And now you've got Saudi Arabia's direct involvement. Talk about the significance of the kingdom's financial investment in the industry. What message does that send?
So I think if you look at esports, right, specifically the last 10 years, it has been on a super growth path. When it started to fill stadiums, it really became seen as a sport, right? The question if this is a sport was basically gone. And with Saudi Arabia investing, since a few years into it, it became on the global level. Before that, it was very much a private investment, so to speak. It was the publishers themselves who run the games and own the games. It was private companies, but no governments involved like in traditional sports. And now with Saudi hosting the Esports World Cup, it's the first time that a country directly invests into a sport at a scale of traditional sports, and that you can see leadership of a country directly supporting it and actually, publicly announcing that they're big gamers themselves.
Yeah, so let's talk a little bit about the upcoming 2025 Esports World Cup. What is new this year round? I read that chess, which is not a new sport, it's a 1,500-year-old game, is actually going to be featured. What does a chess competition look like in the context of esports?
Well, if you go a step back, right, what is esports? Esports is competition on video games. So everything you can play, and play is the right word, with a computer, a console, and a mobile phone is potentially being in esports. And if you look at chess, it's a board game originally, but obviously being played on all of the devices I said earlier. In the last few years, chess has exploded as a viewership sport as well. Mainly, again, in a more esportish style, playing online competitions, live streaming on YouTube and Twitch. So very much adopting the esports way. So it felt like very natural to include chess as part of the Esports World Cup 25 as one of the new features. And we announced a 3-year cooperation there with the biggest chess platform in the world, chess.com. It was Magnus Carlsen as ambassador. And actually, if you go one step back, what is the Esports World Cup about? It's about the biggest esports club in the world, winning across 25 different disciplines. Yeah. So each discipline's a little bit like the Olympics, it's its own sport. And chess now is a full-fledged one of those. And therefore, all the big clubs have invested. And it's a real crossover between that traditional esports world and the classical sports world of chess.
Well, Ralf, I got a taste of that actually watching this documentary that RJ Cutler just put out, Esports World Cup Level Up. I just want to play a clip from an interview that we had from him last week where he talked about the complexion of these athletes. Take a listen.
What we learned is that we're dealing with world-class athletes who are at the top of their game. It's not the cliche of gamers who are kind of, buried in their basement and not big personalities. You're talking about players whose profiles and fans whose passion and enthusiasm is as strong as you would see in the NBA today.
The enthusiasm, Ralf, that RJ has for this, and the enthusiasm I got from watching that docuseries, and when you talk about all the players that are showing up for this, 1,500 folks vying for something like $60 million a pot of money, 21 different games that we're playing here. And I am curious that when you look at the preparation that these folks have and the uncertainty that's around that, is there anything comparable that you've seen in other sports or even just other fields that is intense as what these folks are putting themselves through?
It's actually, as you say, it's almost more intense because it's a little bit less physical. So the time you can invest is a little bit larger. But it's to turn this around. This is their full-time job. And it's not for them only about being good or very good in it. They need to be the best in the world. And that comes with a lot of dedication, passion, and skill. And you can see it in all of these stories. And then great that you brought up Level Up, right? It's out there on Amazon Prime for everyone to watch. it greatly explains the why these generations are all so much into esports and what you can achieve almost without borders, right? Because some of these kids come from all over the world, and different than in some of the traditional sports where the barrier to entry is very, very high. In esports, all you need is a mobile phone, and that's accessible all over the world.
I am curious, though, about the business model, not only for this tournament, but really for the esports ecosystem as a whole. There's been a lot of discussion that despite all of the attention that it's getting, it has not necessarily translated in total into a profitable product. And I am curious that when you talk about the build out of these arenas to hold these, finding the sponsors, getting television rights and things like that, when do you expect to see a little bit more of an acceleration on that front?
Mm-hmm. So I think, if you go on the traditional revenue fields that it has, it's ticketing, sponsorship, merchandising, and so on and so forth. Esports is doing fine. I think the problem of the last few years there were some investors coming in who expected this to go like traditional sports with huge right fees going, to the moon very quickly. I think if you look at the media landscape of today, rights fees overall are about to go down. This is the first football leagues that are going down. The big American sports are still going up, but a lot of the second line sports are going down. And therefore, I strongly believe that esports and actually all sports will trend less against huge media rights contracts and more against direct fan monetization. So what is there in the future of esports to make it as profitable as it's supposed to be and get there? It's number one, stronger engagement of players and fans and direct monetization of them. But number two, something that's a lot forgotten, is actually involvement of governments and states. Because in the end of the day, sports is seen in all of a society as a cultural good, which brings social society together. And the biggest sports events are a huge societal happening. And both of these things will, and we can already see that in Saudi, we can see the future with the Crown Prince, being way below 40 years old and growing up with video games. That's not an outlier. That's actually the future we see there.
Ralf, really wishing you the best and hope to get you back on soon to talk a little bit more about this. Ralf Reichert is the CEO of the Esports World Cup Foundation, the Esports World Cup kicking off in just a few days in Riyadh, Saudi Arabia. All right, when we come back, we're going to refocus on the market here at home and one of the biggest decliners of the day, and that is Centene, the health insurer having its biggest drop in about 2 decades. We'll explain why. It's our stock of the hour, and it's up next. This is Bloomberg. Time now for our stock of the hour, and it's a doozy. Centene, the health insurer, down 40% on the day, its biggest drop as a public company. This after the health insurer withdrew its 2025 profit outlook, citing rising risk around the Affordable Care Act. Bloomberg's John Tazi joins us right now for more on this story. We should point out some of its competitors: Molina having its worst day since 2012, Oscar Health having its worst day since 2022, Elevance down the most since 2020. What's going on?
Yeah, so Centene withdrew its guidance yesterday. What they have said is that basically the Affordable Care Act insurance marketplaces are shaping up to be, they're growing more slowly, and the population is sicker than what the company modeled. That's leading to some dynamics where money they thought they were going to get through some complicated mechanisms designed to spread risk around in the markets is not going to come.
We're also seeing shares of United Health lower, and I bring that up because United Health not so long ago also withdrew its full-year guidance. How similar are the things that they're experiencing?
Yeah, it seems like there are different kind of underlying dynamics of different businesses. United Health called out medical costs in its Medicare health plans, but big picture, these are both companies that get a lot of money from taxpayer-funded healthcare programs, and we're seeing some of the risks from that emerge.
And they are struggling with visibility at a time when they can't afford to.
Yeah, I mean, one of the things about these businesses is like you're an insurance company, right? Your job is to like sort of look around corners, understand, forecast the future, and we've seen it's it's unusual to see these companies totally withdraw their financial outlooks like this, but now we've seen it twice in a couple months.
But the big question is, how do they adjust? I mean, if this is the new normal, if you believe that, and it does seem like the trend line, at least for this new administration, which is still relatively new, is moving in that direction, how does a Centene adjust to this, if at all, other than just pulling back completely from some of these markets, which is pretty much their entire business?
Yeah, I mean, so we're going to find out more about that when we hear from management in a couple of weeks. They report earnings later in July. I think it's one thing is they can reprice their products, and they've said that they are going to do that for 2026. What that means is insurance premiums are going up, right? That means they are.
Who, though?
In this case, for people in the individual Obamacare, Affordable Care Act.
So that will go up for an individual, because they're not going to dare try to do that, play that game with the actual government, because the government will push back.
The government subsidizes these plans. The government federal subsidies help people afford these plans. So if you're on a full subsidy, maybe you don't see the impact directly, but the rates are going to go up, and some of that is coming from households, and some of that is coming from taxpayers.
Gotcha.
This is for 2026, so we won't see the impact until 2026 either.
In terms of, rates for 25 are set for the most part, but as these companies are always looking to reprice their books for future years.
All right, John Tozzi, Bloomberg News reporter, thank you so much. And Romain, that gets to that idea that a lot of people are expecting inflation to pick up in the later half of this year. John's given us a reason to think that at least health insurance costs will go up in 2026.
Yeah, and of course, we've seen a lot of provisions coming out right now in the budget bill, working its way now back in the House of Representatives, which of course includes a lot of provisions that would, at least for certain segments of the population, increase their health care costs.
All right, coming up, we're going to take you to the closing bell with Sandy Pomeroy, Senior Portfolio Manager with Neuberger Berman. That is just ahead as we look at an S&P 500 holding near record highs up 0.4%. From New York, this is The Close on Bloomberg.
To us, the sensitivity on the Fed is on inflation, and while we haven't seen it in the numbers yet, we are expecting to see it perhaps as soon as the CPI report in the next couple weeks.
Zach Griffiths over at CreditSights kicking us off to the close just about 50 minutes ago. Of course, referring to maybe the action that we're seeing in the Treasury space, long end yields higher on the day. But we turn back to equities here, another record high for the S&P.
On this pre-jobs day, you have the S&P 500 setting yet another record high, resuming its rally. The president announcing a trade deal with Vietnam. Small caps outperforming big caps for a second day, and that's really been the trend over the past month, Romain.
Yeah, absolutely. And it gets to this idea, are people betting on, I guess, a little bit less chaos, a little bit more certainty, and maybe that puts these economically sensitive companies, particularly the smaller and mid-cap ones, on much more stable footing than what we thought just, 2 or 3 months ago?
And we have the volatility coming down. The VIX currently about 16 and change. The big story globally is the slump, I want to call it a plunge. It is a plunge in the pound. You have a lot of concerns about fiscal spending in that country after the prime minister failed to give his full backing to the Chancellor of the Exchequer, their version of a Treasury Secretary.
And of course, the moves that we saw in yields over there, that trickled across the Atlantic here into the U.S. Fiscal concerns as well as that budget bill in the U.S. Congress continues to work its way potentially to the president's desk. As we move closer to the closing bells with an eye on the market gains of the past and what could move the market in the future, Sandy Pomeroy joins us around the desk, Senior Portfolio Manager over at Neuberger. Berman, Sandy, great to have you.
Thank you, Romain.
Closing out a pretty strong quarter, a pretty strong first half, particularly given all of the negative things that were going on out there. There were a couple of stories, though, that I found really surprising. And one was the incredible strength that we saw in financials. As we speak right now, you have a KBW Bank Index on a 10-day run. Right. You have certain pockets of the finance space that are either at or near record highs. And I am curious what's driving that, because that's not necessarily just a bet on economic activity or consumer resilience, or is it?
I think that's both part of it. I think the whole credit picture looks actually very, very good, and that's a great backdrop for the banks. Then you also have this regulatory easing up of their capital requirements, which is going to allow more dividends for us. We run an equity income fund, and we're looking for companies that can pay good dividends and grow those dividends, somewhere around the double-digit level, and the banks fit that mold perfectly right now.
Well, I'm curious. So, like yesterday, when we saw some of the banks come out with their announcements on returning cash to shareholders on the back of that stress test, basically all of them, J.P. Morgan, Bank of America, Wells, State Street, I'm forgetting a few others, all boosting their dividends, some pretty significantly here. Did you expect that?
Well, we knew that they all had a lot of excess capital, and it was really just a regulatory, construct that prevented them from dividending it more out to shareholders. And now we've seen a relief on that front. And so, yes, I mean, we were anticipating that it would happen if we saw the regulatory relief. It happened. And we think the story is actually quite positive. As I said, the credit environment's benign. There is some economic growth, and we've got now less capital restrictions. So it's all good.
Sandy, is that just a big bank story, or can it be expanded to regional banks as well?
So the regional banks, the thing that I worry about a little bit with the regional banks is that when we had higher inflation and the Treasury bond went up, a lot of these banks found themselves a little upside down in terms of their balance sheets. And depending on what happens with inflation going forward, that could come back into the fore and could be an issue. And so it's something that we think is enough of a risk that we would favor the big banks instead. They also are more diversified. If they've got a big credit card business, as well as in many cases, some sort of investment banking business, very capital markets driven, in addition to the standard lending and whatnot.
Got it. So it's not just a net interest income that's
right,
keeping
it's
them
not
afloat.
just a net interest story.
Let's talk about industrials, because you also like aerospace and defense, which has been strong. There's a good narrative that goes along with it. But we know that people have been bidding that sector in Europe higher. How do U.S. defense and aerospace stocks compare to the European sector?
So I think that historically there's been much less growth with the European names and also with some of the Asian names. And now we're entering in almost a sweet spot here because of the European spend that's they've promised. We anticipate this is going to be a much longer cycle than we've had in the past, and it's going to be an accelerating revenue story for a lot of the longer cycle names. So we like BEA Systems. It feeds right into that narrative. And then the other one we really like is ST Engineering, which is a Singapore-based company that is both commercial aerospace and defense, but really niche company that is, in our minds, very inexpensive and has a great dividend profile, and we think that it's going to be able to grow. So that's just our sweet spot.
There's been a lot of talk about new entrants into the defense and aerospace space, if you will, particularly amongst a lot of, I guess, potential startups and investors who would have normally gravitated to, I guess, what we call more traditional technology, which is basically just helping you, hail a cab or, buy a burger or something. But this idea that we're headed for maybe a longer period of potential geopolitical and military instability, and that's going to require not just more weaponry, but more things with regards to surveillance and other things. Are you interested at all in maybe some of those companies in that space that are maybe still niche, still small, but could potentially ride this wave if you buy into that argument that we are headed for more spending in this space?
I think it's personally very exciting. Professionally, because I run an equity income fund, it's harder to buy those names because they're in growth mode, they're consuming capital, they're not paying it out to shareholders. But I think these new technologies that are evolving are so interesting, and I hope that what it does is it brings the cost of defending the United States or just being more resilient cheaper for us. And so I'm rooting for them to be very successful.
Another big theme in investing right now, of course, is everything that's going on with energy consumption as it relates to artificial intelligence and data centers. As someone who is focused on income, you didn't mention utilities or energy stocks at all.
Well, we like both, so I don't mean to diss them in any way. Utilities are just more steady Eddie. I think that they will participate, but I don't think they're going to be the super winners in this. But the big difference with utilities is for many years, the last decade or plus, we didn't see much growth in energy demand, and now we have it. So this is a very positive story, very positive backdrop for the utilities, and they're going to have to spend more money to bring that grid up to shape. So that's a good story. Energy, my favorite area of energy is offshore drillers.
Really?
And yeah, it's
Okay.
very niche-y little part
Yeah.
of energy. There's a lot of evidence that the U.S. shales might be flattening out and maybe will not be able to grow again, even with a higher oil price. And so the next frontier, so to speak, is going to be offshore. And they haven't added any new capacity in offshore drillers in over a decade. And so as that capacity gets absorbed at better and better pricing, I think that these are going to be good stories. And Noble Drilling is the one we own in that space, which pays a good dividend.
All right, Sandy, always love it. Have a wonderful holiday weekend. Sandy Pomeroy, Senior Portfolio Manager at Neuberger Berman, counting us down to the closing bells. Scarlett, stocks pretty much where they were when we started the show, fractionally higher for the S&P, bigger gains for transports and the Russell.
Sandy mentioned energy, the biggest gainer in the S&P 500. Utilities down about 0.9% on the day.
We're going to have a full breakdown of all of today's market action with our global simulcast right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlett Fu, taking you through to that closing bell with the global simulcast. It starts right now. Carol Masser in the radio booth. Matt Miller in today for Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube, with the S&P, Carol Masser, at a record high. Small caps outperforming them all and big moves higher in Treasury yields.
I know. So what is it? Like just enthusiasm? Is it trade? Is it the deal? The massive spending and tax cut bill working its way through. I mean, it's pretty interesting to see this enthusiasm, and I'm just kind of again thinking about earnings that are coming up in a couple of weeks, whether or not it will support all of that. What?
You continue to do your best not to say one big beautiful bill. That's what it's called, okay?
OBBB.
We've been going back and forth a little bit on
I like
this.
1B3. Look, I think
It's
you
marketing.
get
I have
some
a hard time
sense
with
of
that.
certainty, right? Every administration does marketing with massive legislation. We've seen that before with the, for example, the Inflation Reduction Act, which also didn't reduce inflation. But the point is, you get a little bit more certainty here, and so people are willing to take more risk in this market.
Well, I mean, we'll have to see where it goes because right now it's still stuck in the House. They haven't really moved forward with that yet. So the next couple of hours is definitely crucial here. Don't forget, we also had the trade deal with Vietnam. So that's now, what, 3, right?
Yeah, they're going to pay us 20% tariffs on all the goods they ship here.
40% for the transshipment, right?
Yeah.
Is that how it works? Okay. All right. Well, we did get some news on the trade front that is a net positive for stocks, assuming that there is follow through and that bill working its way through Congress, that big budget bill. Hitting some sticking points as House Republicans try to sort out the nitty-gritty. But right now, the betting is that will somehow make it to the president's desk over the next few days. We take a look at the markets here on this Wednesday afternoon. The Dow Jones Industrial Average is going to finish out the day unchanged, but you had a lot of activity for the other indices on the day. An S&P 500 back above 6,200, up 29 points or 0.5% to a record high. A NASDAQ 100 at a fresh record high. A NASDAQ Composite up almost 200 points or 1% on the day. And a Russell 2000 outperforming them all with a gain of about 29 points or 1.3%.
Yeah, nice to see that, right? Going back to the S&P 500, guys, 286 names higher in the S&P 500 today, Scarlett, 213 to the downside.
All right, let's take a look at the IMAP. A pretty mixed day, although there are more advancers than decliners when you look at the industry groups. Energy stocks gaining 1.7%. They're the best performers, followed by materials and tech, each gaining more than 1%. Your laggards are healthcare, and that's really on the back of Centene plunging, and utilities as well as financials, which had gotten boost in recent days.
All right, guys, let's go to some outperformance that we've seen. I want to go to actually an index, the S&P Global Clean Energy Transition Index. I wanted to pull that up because that is up about 1.7% higher today after U.S. excise tax seen as an existential threat to the solar and wind industry was stripped from the Senate GOP tax mega bill that passed the chamber in that tie-breaking vote yesterday. A Goldman Sachs index of renewables, by the way, trading at a fresh 2021 high. Renewable stocks around the globe we've seen rally also because we had another story on the Bloomberg that just talked about these green-related stocks, despite being so much under pressure by the Trump administration, enjoying their best quarter in almost half a decade. So I just wanted to pull that out. We saw a bunch of names in this sector higher. In fact, First Solar, let's go to that one, up 4.6% at the close. It was up as much as about 9.5% earlier in the session. It's a top gainer in the S&P 500. So again, having to do with that Senate budget bill that passed through and some of that excise tax, as we said, pulled back. Yeah, we saw those names going higher. Sorry, I'm really tired today.
Carol's having a tough day.
I'm having a tough day.
But the good news, Romaine, this is her last day in the office this week.
You guys are going to have to carry the mantle tomorrow. Tesla, let's go to Tesla. Up 5%, a top gainer in the NASDAQ 100, the second top gainer in the NASDAQ 100. Again, up about 5%. Carmaker posted a less drastic decline in vehicle sales than most pessimistic analysts feared. It was down 13% from a year earlier, but some had thought it could be down maybe more than 20%. So, kind of a sigh of relief for those Tesla folks. All right. Take it away.
All right. I am looking at the losers, and Tesla's not one of them, even though those deliveries really massively missed what people have been expecting. So anyway, Centene is, I think, the big story. I had a huge argument with my open interest co-host, Katie Greifeld, this morning. I wanted to do this story, and she was like, who's heard of Centene? Well, it's a $28 billion insurer that has 28 million customers. It's gotten rocked because of that big, beautiful bill. Most of Centene's business is Medicare or ACA, and that obviously being scaled back, and this is going to result in earnings headwinds of as much as $1.8 billion. A lot of analysts, or at least two that I saw this morning, cutting their view on the health insurer, maybe more now that we're at the close.
It really goes to the idea that these health insurance companies have been so consistent with being able to project out what their financials look like that when they can't, this is the kind of reaction they get.
Yeah, absolutely. And they're bringing down a lot of other healthcare companies with them. Molina, I haven't pulled these up, but Molina, Elevance, Oscar Health are all big losers today. I want to move on to Intel because the chip maker is off at the close after Reuters reported that the CEO, Lip Bhutan, is exploring a potential strategy shift in the foundry business that would entail no longer making or marketing certain chip-making technologies to external customers. Reuters citing people familiar there. We haven't independently confirmed it, but you can definitely see that the shares are off 4.25%. And then I think Adobe is an interesting loser today because of a big winner, right? Figma is expected to be one of the biggest IPOs this year. It almost got sold for $20 billion a couple of years ago. So it's a software design startup. It only has like less than 250 million in revenue a quarter, so I guess $1 billion a year. 20 times sales seems, I guess, okay for this kind of what I'm told is a very sticky software service that could really impinge on Adobe and compete with that company. And that's why Adobe is having a tough day in the market today, down 3.5%.
All right, a lot of activity in the equity market today, but even more activity when it comes to bonds. Treasury yields, bear steepening on the day. As you see the mismatch there between what we see on the shorter end of the curve and the longer end of the curve. Yields higher on your 2-year by only about a basis point, but up about 4 to 5 basis points when you go from 10 to the 30-year levels. We should point out some of this is related to some of the fiscal issues going on here in the U.S. and some of this, of course, a bit of a rollover from what transpired over in the U.K. earlier today with some concerns about the fiscal situation in the U.K. and whether their equivalent of the Treasury Secretary, Rachel Reeves, the Chancellor of the Exchequer, will keep her job.
Yeah, some big news out of there and certainly volatility in the markets there. Hey, listen, something that's causing some volatility in our world is artificial intelligence. And there's a great story by the Press Association about Wimbledon and their use of AI line calling, so artificial intelligence line calling. And a former top Wimbledon line judge has basically hit out at this and said, doesn't like the switch to these automated calls, saying, Matt, that it makes the court, quote, look like bad Photoshop. And this is Pauline Eyre. She's from North London, and she doesn't like it.
She doesn't like it? I mean, I get it. Why would Wimbledon do this? They still make people wear all white. So, stick with the old, stick with the traditional. But of course they already have the Cyclops and have had it for what, 2 decades?
Yeah, I mean, this seems a little bit like sour grapes. I mean, I understand why she would be upset, but the idea here is that it's more accurate. And it doesn't really seem to address that issue, which is, of course, the tennis players that for years argued about this idea about the human fallibility of these calls. And if you can use technology, and look, we've seen this play out in other sports, right? Whether it's MLB, whether it's in the NFL, where you can take certain elements of the game, rely more on computers and cameras and other things to ensure that what's being called is actually supposed to be called.
We'll never have a moment where John McEnroe yells at the line judge and throws a major fit like he did in 1981 at Wimbledon.
That's the most important. Look, I think
viral moments.
In other sports, it's great, right? You want AI calling offsides in soccer because it's frustrating when that call is bad, but you also want to see John McEnroe throw his racket, don't you?
Well, who wants to see dinosaurs this weekend? Jurassic World Rebirth opens today. This is the 7th movie in the Jurassic Park franchise. I like the first one. I don't think I've seen any of the other ones.
I have not seen any of them since the first one.
There's ScarJo. She's in it. Jonathan Bailey from Bridgerton, also in it.
All right. Good-looking people and dinosaurs.
And dinosaurs. It should be the other way around. It should be good-looking dinosaurs. Oh, and some people.
Let's go to the movies. All right, guys, that's a wrap. Have a good and safe holiday. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Matt and Romain will be back here, right? Closing the bell tomorrow.
I hope he's ready to chill with me.
Yeah. Well, maybe he's
I like
ready
to take my time,
Yeah.
I like to marinate on things.
All right, well, they're going to continue on TV. We're going to continue here on radio. All right, guys, we'll see you tomorrow.
All right, our coverage continues right here on Bloomberg Television as we keep an eye on what's going on in Washington with that budget and tax bill trying to make its way out of Congress. And of course, an extension of those 2017 tax cuts. When we come back after the break, we talk to the architect of those tax cuts, Kevin Brady. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romain Bostic here with a look at how markets finished the day, and they finished the day strong. After a little bit of trepidation yesterday, the S&P back to record highs, up about 0.5%, primarily on the back of some optimism about some of the issues coming out of Washington. You saw that reflected in cyclical stocks, particularly in the small and mid-cap space, with outperformance by the Russell 2000. Bitcoin getting its mojo back, and an ETF tracking Vietnam stocks actually had rallied as much as 2% before pulling back just ever so slightly. This after President Trump tweeted out about a potential trade deal with Vietnam. When you take a look at the individual movers, there's one sort of thread that brings them all into common, and that is that they're all being influenced right now by policies coming out of Washington. Robinhood up about 6% to a record high on this day, primarily because of recent legislation supporting the crypto industry. First Solar having a phenomenal rally, up 5%, as a lot of the other renewable energy stocks also moving higher on the back of some key provisions in that congressional budget bill that's working its way. Capital One also closing out at a record high on the day, largely once again because of some favorable moves coming out of Washington on the deregulatory front, and even Nike getting in on the action, up about 4% on the day. And again, that's largely tied to that potential trade deal with the U.S. and Vietnam. And that does bring us to our top story here, and that is what's going on in Washington, specifically the fiscal situation. And it's a fiscal situation on both sides of the Atlantic. The drama earlier today was in the UK. The Chancellor of the Exchequer, Rachel Reeves, moved to tears in Parliament amid doubts about her job security as Britain wrestles to find ways to fill a fiscal budget hole. We saw 30-year UK government bond yields surging 20 basis points in a market sell-off that was very reminiscent of that trust moment in 2022. Now, that sell-off in UK bonds crossed the pond to Washington, D.C., where the U.S. government is contending with its own fiscal choices. 30-year Treasury yields rising the most in a month as investors really hone in on concern that widening budget gaps could undermine the economy and markets. Now, this is a multi-decade-long concern out there, but it has been given a sense of urgency as Donald Trump's sweeping tax and spend legislation moves closer to passage. Now, a key component of that bill is $4.5 trillion in tax cuts that does include permanent extensions of the 2017 tax relief that was passed during his first term. One of the architects of that 2017 tax cut was House Ways and Means Chairman Kevin Brady. I'm pleased to say that Mr. Brady joins us right now here on The Close. Of course, the former Republican representative from Texas, a member right now with the Alliance for Competitive Taxation and an advisor at Akin Gump. Great to have you here, Congressman Brady. I do want to go back to 2017 and how you guys worked out these tax cuts at the time. It was you, Paul Ryan. I know a lot of other folks were involved in this as well. This, of course, is back on the table. We knew the expiration was coming, and now there does seem to be meaningful progress in ensuring that not only are they extended, but potentially made permanent.
Yeah, I think this is incredibly pro-growth from the standpoint of locking in the reforms from 2017, certainly the lower rates for corporations and small businesses, really key to growth. Locking in the redesign of the international tax code that made us so much more competitive. And I think in this case, in this bill, making permanent some of those innovation incentives like research and development and expensing, really perhaps the most pro-growth provisions in this bill, making them permanent, fully restoring them, really is key to our ability to win the innovation race as a country.
I am curious, though, about the distribution. I mean, as you know, Kevin, there was a lot of criticism about the 2017 cuts, that they were maybe a little bit too lopsided towards corporations rather than individuals. When you guys start to map out the economic benefits of something like this, what conclusion do you come to with regards to how these types of, for lack of a better word, stimulative measures should be distributed?
Yeah, so the 2017 tax cuts were the reverse. 3 out of every $4 in the tax bill went to families and small businesses. Corporations, in fact, paid for most of their own tax breaks. Corporations paid 80% of the lower corporate rate, bringing it down to 21%, because they believed economically they'd be stronger, U.S. would be stronger. And from a distribution standpoint, the big winner in 2017 were workers, because wage growth, real wage growth above inflation, in the first 3 years, the 9% increase is the highest on record. So families were getting ahead each month at record levels. In this case, continuing, creating that certainty avoids a huge tax hike and certainly avoids the risk of a recession if those tax hikes were to go into place. They've been very careful really to approach this in 25 from sort of 3 standpoints. One, how to create certainty and lock in the Trump tax cuts from 2017. How do you add the president's campaign priorities and other improvements, including in the international space? And the third area is, how do you cut spending in the federal government to help offset, some portion or a good portion of this of the tax cuts over the long period. So this is a little different mission in 2025, but no less difficult, especially since they have just razor-thin majorities in the House and the Senate. Really, the degree of difficulty is very high.
Absolutely. And it's not just that it's razor thin, but I mean, as you know, Kevin, I mean, you have a certain faction of the Republican Party that for years has been banging the drum about deficits and debt servicing and the fiscal damage you can potentially do with these types of tax cuts. When you guys passed this in 2017, we were in a much better situation, relatively speaking. I think we were something like 3% of GDP with regards to our deficit. We're double that right now. And some of the projections that we've seen from the CBO, from Yale, and other folks say that this bill would likely exacerbate that ratio.
Yes, so, you're right about debts and deficits. They've grown dramatically. In the last 4 years, we've averaged almost $2 trillion in added debt each year. There's no question the tax cuts will have an impact spread out over a decade rather than year by year. And certainly you can see Congress is working very hard to try to create the savings that can offset some of that. My sense is, the way Republicans see this, is that in addition to this bill, they expect to see higher growth and higher revenues than projected, which did happen in 2017. They see revenues coming in outside the bill, such as tariffs, perhaps $2 trillion or more, that would have an impact as well. And then I think what you will be hearing about in the conversations with members of Congress and President Trump in the White House today with members of Congress is what more can be done, perhaps in a future reconciliation bill later in the year that can tackle more savings. What the administration will do in Congress in its budget, in its own sort of tightening the belt measures. So I see this Congress looking at it beyond just this bill, but as a whole of government. How can you reduce the size of this government? Try to move back toward the size of government before the pandemic.
I am curious, Kevin, how you think this is going to play with the rank and file electorate. Once, assuming this passes and folks have to go out on the road, go back to their districts and actually sell these provisions, do you think the public is going to buy it?
You know, I do, from the sense that there will be a sense of relief from not having tax hikes on middle-class families. Certainly some of the president's provisions are hugely popular, like no tax on tips and overtime. The relief to about 88% of seniors on their Social Security taxes, I think, will be very popular as well. Increasing the standard deduction in the child tax credit, I think, have support broadly among the public. And I will be honest, the reason we did not fully extend the child tax credit, the middle class cuts, and the small business deductions is because they are, in a bipartisan sense, so popular. And we felt like these are tax provisions that either party would want to continue in the future.
All right, Kevin, really appreciate you taking time for us. Of course, that's former Congressman Kevin Brady, also former chairman of the House Ways and Means Committee, of course, represented the great state of Texas for several years there. When we come back, we're going to continue on this topic as we continue to keep our eyes on Washington. But we're going to talk a little bit less about the budgetary effects of this bill and more about the human and inflationary aspects of it. Stephanie Kelton going to be joining us after the break. This is Bloomberg. That budget bill working its way through Congress is hitting some resistance among House Republicans. Concerns here about what the impact would be on the fiscal budget, on the fiscal deficit and the economy. Our next guest, though, says the budgetary effects are maybe a little bit less of a concern for her, and she's much more focused on the human, environmental, and inflationary impact. Let's bring in economist Stephanie Kelton, professor of public policy over at Stony Brook University. So when you talk about the human, environmental, and inflationary impacts, what do you mean?
Well, I mean, the human impacts, what's getting a lot of attention, and I think it bears repeating, is that, you know, anywhere from 11 to 16 million people stand to lose their health insurance coverage as a consequence. 3 million or so will lose food assistance. So that's what I mean when I talk about the human impacts. You talk about things like what this bill does to energy policy, and you think at a time in which we need to be producing energy, we have AI, we need to be able to feed the grid and to supply the energy that people need. We don't need rolling blackouts. We don't need energy costs soaring, exacerbating a cost of living crisis in virtually every state across this country. So that's the kind of thing I mean when I talk about energy. So energy and inflation, you know, what are the inflationary impacts of this bill? If you look at the way CBO scored it, it's de minimis. They say there's essentially no inflation impulse associated with this massive bill. That may or may not turn out to be correct. It's very hard to gauge when you've got moving parts with tariffs and immigration. It makes it much more difficult, in my mind, to think about the inflationary impacts. But those are the kinds of things that concern me.
I am curious, and I asked Congressman Brady about how members of Congress are going to sell this to their constituents, assuming it does pass. There's been a lot of studies showing that the lower income folks will certainly see some benefit, some direct financial benefit. But it also shows that people at the top echelon, the 1%, are going to see an incredible outsized benefit that is disproportionate to what the lower income receives. How do you sell that?
Well, I don't know, and I would say people at the bottom would see a benefit if they were just doing the tax cuts. If this looked more like 2017 than this new bill, if they were just extending and then building with some no tax on tips and overtime and that sort of thing, absolutely, there's a little bit of something for everybody. But that's not what this bill does. This bill takes the tax cuts, extends them, adds a little bit of temporary stuff for the next few years, but then
then takes resources away in the form of cuts to Medicaid and food stamps. So if you look at Penn Wharton, if you look at CBO, if you look at the other estimates, people in the bottom decile, bottom 20% lose enormously. $1,600 a year on average for people in the lowest 10%. That's $16,000 over the budget scoring period.
This gets to something that you've talked about before and written a lot about before, which is the idea of whether deficits matter and the idea of, I guess, the direction of where those deficits, where that money essentially is going on, because some of these programs are being stripped ostensibly to pay for the tax cuts.
Right.
And I do wonder about the idea of the distributive effects of bills like this and whether we're doing it properly.
That's what's going to be very difficult to sell. It's hard to imagine, again, if you could have just done sort of what I'll call normal Republican things. Do the tax cuts, do some deregulation. That stuff's easy to sell. And, you know, did it produce an enormous windfall? Did we get the 6% GDP growth that President Trump talked about back in 2017? No. But did it help at the margins? Yeah. The economy grew a little bit faster. Unemployment went down. It didn't create an inflation problem. But this time, you've got these, you know, $1 trillion plus cuts to programs that millions and millions of families depend upon. The potential for rolling blackouts. I mean, we're talking about something that's going to be really hard to defend, much less sell, once it all starts to take effect.
Do we need stimulus right now? When you look at the state of the economy, do we need this?
You know, we were doing okay.
Yeah.
We had the wind at our backs. If you think about where we were at the start of the year, the U.S. economy was the envy of the world. This was an economy that was sort of, you could have left the thing on autopilot and we would have still been the envy of the world. It's very hard for me to understand why you'd come in and kneecap this economy with tariffs and then a whole bunch of spending cuts and the like. So did it need stimulus? No. But is this the kind of policy that's going to put us in a better place? Are we going to be more competitive vis-a-vis the rest of the world in terms of energy policy and the economy? No, I don't think we are.
All right, Stephanie. Well, we'll see how this shakes out. Of course, if it gets passed and once it does, the implementation and the salesmanship that will have to take place as we go forward. Stephanie Kelton, professor of public policy and economics at Stony Brook University. We'll be back in a moment. This is Bloomberg. Welcome back with our focus on the budget and economy. Today, we push ahead to a big jobs report tomorrow on Thursday because of the holiday shortened week, 8:30 a.m. Eastern time. The June jobs report. The median estimate in a Bloomberg survey is for 110,000 jobs to be added to payrolls and for the unemployment rate to tick up by 0.1%. We've seen a range of estimates from Wall Street economists, so on that headline payrolls number from as low as 85,000 to much more than that. Our next guest says 100,000 would be consistent with the gradually softening economy. Citi's global chief economist, his name is Nathan Sheets, and he joins us right now in Studio 2. Nathan, great to have you again.
Good to be here.
All right, so 110,000, I mean, that's not bad, but I know it's not necessarily what we've been used to, and I think if you look at historical averages, certainly below. Are we looking right now at a softening labor market?
My sense is that during the first half of the year that the economy has slowed a notch relative to where it was during the second half of last year, but that's hardly a surprise. It was a red-hot economy. It was a red-hot labor market. And for quite some time, economists, including me, have expected this economy to slow down. And I think we're seeing that. So there's a natural slowing process going on. And then on top of that, clearly the tariffs have created uncertainty that's weighing on spending in some parts of the economy. But this is the important point, and one reason why the economy hasn't slowed more is it's accelerated spending in other parts of the economy, where consumers have brought forward lots of purchases of automobiles, of smartphones, of computers, and so forth.
In the short term, there's a lot of people looking at the layoff picture, saying, look, you aren't seeing a lot of layoffs, a lot of fire. I know that we have a few companies out there like Microsoft that have had some pretty sizable layoff announcements. But overall, if you believe what Jay Powell says, if you have a job, you're probably doing good. Now, if you're out of a job right now and looking for one, maybe things are a little bit dicier.
Yeah, I think that nails it. What we're seeing in the labor market is a gradual softening of labor demand. And I think that reflects two facts. One, in recent years, there was a hiring binge. We had a huge amount of hiring over the last couple of years. And then at the same time, we're also seeing reduced inflows into the labor market, reduced labor supply. And why is that? It's primarily because we've clamped down on immigration and border flows.
Yeah.
So putting that all together, folks that are entering the labor market now and looking for jobs are not going to find as much opportunity as they did a few years ago. But all in, I look at the JOLTS data and some of the other data suggests maybe it's still okay. It's still an okay labor market. It's just softer than it was.
I am curious on the immigration side. I know there's been a lot of studies about some of the strength that we saw in the labor market over prior years and how much immigration actually played a role in that. If you are seeing a clampdown on immigration into this country, wouldn't that in effect create some degree of a labor shortage, and wouldn't that be beneficial if you are looking for a job?
I think that this dynamic you describe is very accurate, right? That over time we might see elements of labor shortages in the economy. But the reality is that the size of the flows in recent years has been so large that we're still seeing a diffusion of 2022 and 23 and 24 immigration flows in the labor market. So I don't think we're anywhere close to being short labor, especially in this environment where labor demand is pulling back. But if we continue with these policies for several more years, could we get to a place, say in 27 or 28, when we have serious shortages and broad macro shortages of workers in the economy? Absolutely. I think we saw what happened after the pandemic when we didn't have immigration for a couple of years and we were short workers.
Well, then looking long term, there is another big question with regards to the complexion of our labor market, and that's the idea of increased productivity, specifically as AI and other related technologies start to get deployed. And if you believe some of the CEOs out there, they say at some point, we can have a company that can maybe operate just as efficiently with half the human beings that we currently have today. Is that something that's realistic, and is that going to have a huge impact on what our labor market looks like?
Well, one of the clear narratives that we're hearing from our corporate clients is in the face of the uncertainty that corporates are feeling, one of the things they're actually doing is accelerating their AI investment in an effort to reduce costs, reduce dependence on labor, and as a result of that, be more profitable. So I think over time, we might have AI on net reducing the demand for labor. For now, I think the effects of AI are more on the demand side, and they're actually creating jobs. And think here, the construction of data centers, the build out of the grid, hardware to run AI, software to implement AI, and then on balance, it's a job creator. But over time, we could move to that other side of the ledger where on net we're losing jobs. That's very much an open issue where the jury's still out.
Yeah, and I mean, and these conversations came up before during the dot-com boom, the advent of computers, and we saw a lot of jobs lost, but we also saw a lot of jobs created.
And that's the way technology has always worked in the past. It means we lose some jobs, but inevitably that new technology creates new jobs. And then I think the question is AI somehow fundamentally different than other types of technologies that have preceded it, in that it is more substitutable for workers than previous types of technologies have been.
All right, Nathan, always smart, always wonderful talking to you. One of the best in the business, Nathan Sheets, Global Chief Economist over at Citi Research, as we preview that big jobs report coming out tomorrow morning. And of course, I'll look ahead here longer term to the potential impact of AI on the labor market, a conversation we're going to have a little bit deeper after the break. As we check in real quickly on how the markets finished the day, fractional gains for the S&P 500, but that is good enough for a record high, and more substantive gains when we look at the small and mid cap space. The Russell 2000 up more than 1% on the day, a tinge of optimism about trade, the budget bill, and everything in between. We'll be back in a moment. This is Bloomberg. All right, let's take a look back at this day in history, 72 years ago, when IBM announced its Series 650 digital computer. It was a less powerful but more user-friendly sibling to its 700 series of machines. For whatever the 650 lacked in speed and memory, it made up with it in affordability. just $150,000 for a base model. That was a steal at the time, given that it cost about $2 million to install one of those 700 series and $1.5 million needed for the Remington Rand UNIVAC, which at the time was a standard bearer for general purpose electronic computer design. But if UNIVAC was the Adam in the digital Garden of Eden, the IBM 650 was the Eve, becoming the first mass-produced computer, allowing the field of computer science to expand, to accelerate outside the niche confines of government labs and megacorporations and into university classrooms, nonprofit research groups, and startup companies. It's been surmised that the vast majority of computer scientists that came of age in the mid to late 1950s and early 60s had their first programming experiences on the IBM 650. That broad exposure is widely credited with spurring a spate of discoveries, including the programming protocols that would evolve into what today we talk about as artificial intelligence. The 650, like the 701, was a continuous computing machine capable of memorizing up to 10 decimal digits. And it was that decimal system, rather than binary codes used at the time, that allowed for a more reliable and faster validity checks of the data outputs. With that, the machine was able to make upwards of 138,000 logical decisions in 60 seconds or less. And that laid the foundation for decision tree programming, most famously exhibited by having computers parse the most and least desirable moves on things like a chess or checkerboard. And it was that gameplay, along with the now famous automated creative writing program to craft short stories, that effectively became early iterations of symbolic AI, which of course would later be eclipsed by research into neural networks and deep learning. Nevertheless, even the most sophisticated of these large language computer models that we know today owe a huge thanks to its pedestrian predecessors spurred by the IBM 650. And that brings us to, well, our next segment, which is on tech and AI. Just earlier today, we learned from Microsoft that it plans to cut 9,000 jobs, its second major wave of layoffs this year. And the cuts are coming as the tech giant looks to control costs while at the same time ramping up its AI spending. But our next guest says, before you rush to fire all these workers in the promise of that productivity boost from AI, maybe you just want to hold off a bit. Jacqui Canney is the Chief People and AI Enablement Officer over at Servicenow, and she joins us right now. Jacqui, great to have you. And I do want to start off there with this idea of the enhancements of corporate productivity by AI and what that balance is going to look like between that improved productivity and the need, or maybe less of a need, for the same number of workers.
Thank you for having me, and thank you for that question. Here in Servicenow, we are thinking about AI and using AI to redesign work and redesign roles and tasks, and then evolve the jobs. So we've created capacity inside our company, and certainly for our customers, to be able to redirect that time to whatever the most valuable next step is. In my own team, as an example, I've had productivity go from 1 employee to serving 400 to 1 to 800. And we've redeployed that capacity to be able to create more use cases, continue to evolve our AI work, and certainly bring better experiences to our employees.
Of course, I mean, Servicenow, one of the preeminent IT software companies. And I am curious, Jacqui, your title, I mean, we introduced you as Chief People Officer, but your other title is a relatively new one, AI Enablement. And I am curious as to exactly what that means. When you talk about AI enablement, is that just getting your employees, your workers, more comfortable with this, or is there something deeper to it?
There's a few pillars that I think about with that, and we want all of our people to know AI, right? And we've gone through that over the last year and a half. The second is, are you using AI? Getting really comfortable with using AI in every part of our company with the 27,000 people that work here. And the third is how you lead with AI. There's a human capital conversation to be had around AI that we believe greatly in here at Servicenow, and that's, you have to bring the people along, embrace the technology, and then you'll get the value of that technology. My job also includes scaling up our ecosystem, so our partners, our customers, and our communities. And that's another 3 million learners that we are bringing education, reskilling, and training to, so that they can be better equipped to implement our products as well as others, but certainly be feeling more comfortable with the use of AI.
One of the biggest fears in terms of the potential for job losses, we've heard a lot about entry-level positions and the idea that some of the tasks that we've seen AI take over, at least for right now, seems to be at kind of the lower level, the entry level point of task. And I am curious as to whether there is still an entry point for college grads and other new folks coming into the workforce.
Sure, and I talk to new job entrants all the time. I'm on the board of a university, and there is absolutely here at ServiceNow a need for our early in careers, what we would call that cohort. We just celebrated over 500 of our interns in a global intern week, where we invested in power skills, hackathons, service days, and we embraced, what they bring in, which is a very AI digital native cohort. So we see that as an unlock in our capabilities to the rest of the company, and don't see us backing off of that at all. It's an important part of our strategy.
As you sort of deploy AI more internally, and obviously I know as given what you guys do in terms of with your clients, I'm sure there is an AI component, of course, that is being pushed to clients, or maybe clients are maybe pushing it to you. I am curious as to how those two intersect, how you use it internally and how you're using it with regards to working with your clients and helping them make money and protect their businesses.
Sure. We are very proud of using our own technology in the company and believe that we should be customer zero, or now on now is what we call it, which means we use our products, we make our products better. We hope that makes them better for our customers. It's a real source of pride. But we use our technology in areas like cutting down the time it takes to be prepared for a sales meeting, being able to understand what perhaps a customer might be interested in versus having to go back through details that would have been more time consuming to do. And those are the products that we also sell to our customers. My Assist is our AI tool. And we absolutely try to show customers the confidence that they can use it too. And that does go a long way.
Jacqui, when we talk about, though, the cost of this, and we sort of led off with the announcement from Microsoft that maybe it was trying to rein in some of its AI spending, how do you balance your own internal costs? I mean, building out AI, implementing AI, incorporating AI can't be cheap.
Right. This is a really good question, too. Not that they're all good questions, but strategic workforce planning is a really important part of our company. Knowing what headcount you need, where you need it, what shape is your pyramid, what locations. And certainly we think about what's the capacity that we've created with AI, and then be able to focus that capacity into the places that we want to double down and invest in. And I think that's really the difference between, how you think about just applying AI and the cost of AI. It's what's the return on investment that you get by applying AI so that you have a more productive, more engaged, more skills in your workforce.
Jacqui, got to leave it there. Jacqui Canney, Chief People and AI Enablement Officer over at ServiceNow. We want to bring into this conversation Deon Nichols, the president and co-founder of an AI company called Forethought. He's citing a new study out there that shows that 40% of agentic AI projects could potentially be shut down by 2027 because of rising costs and unclear business value. Deon, let's get right to it here, because, I mean, we were talking a little bit earlier on the program about the announcement by Microsoft, and they're not the first ones. We've heard from a few other companies over the past couple of months, not necessarily reining in their AI programs, but certainly whittling around the edges at how much they're spending on it. Are you finding a material misuse or disuse of some of the rollouts so far?
Yeah, what we're finding, Romain, and thank you so much for having me on the show. What we're finding is that a lot of vendors who are claiming to be agentic AI vendors are actually doing a lot of experimentation, right? There's, GPT was released in 2022, and there's a lot of promise. And so we see a lot of money being spent on experimenting, figuring out what's going on in AI. But a lot of the value is actually being delivered by companies who are able to take not just generative AI, but actually take agentic AI and deliver real value. And that's in places like customer service with us at Forethought and a few other places. But you're also going to see a lot of wasted spend. And that's what the Gartner report was finding.
We should point out, too, and your company primarily specializes in customer service-related AI tools. I am curious about the effectiveness of those tools, but also about the idea, and I'm sure you know this, Deon, there are a lot of people selling products or promising certain results from their products that haven't necessarily been battle-tested.
Totally agree. So there's a lot of noise in the AI space right now. There's a lot of excitement, and rightfully so. As you pointed out earlier on the show, this is going to be one of the biggest technological advancements of our time, of our generation, really. So there's rightful excitement. The problem is a lot of these vendors are not yet delivering. At Forethought, we're processing over 1 billion interactions per month. And this is for high growth SaaS unicorns, financial institutions, and many, many others. And what we're finding is that with agentic AI, you're able to resolve upwards of 73% of issues in customer service and other operational workloads. And so if you have the right AI vendor, the right technology, you're able to do this. But a lot of other folks are focused on potentially just FAQ-based AI, which is a lot easier to build with generative AI. But building out agentic is a really, really strong and a tough problem, and it really takes the right partner to build.
I am curious, though, Deon, when we talk about how these new systems, or new products, I should say, are built, we've seen a lot of, let's just say, older tech benefit from this. But largely what you're doing is taking some layer of a large language model, putting that on top of the old tech, and then selling it as something new. Why wouldn't that be effective, at least if the old tech we know to be reliable?
So let's use customer service as an example. It is one of the first industries where AI is really making a huge impact across operations teams, across businesses. What we found in our data is that about 23% of customer service issues are FAQ or information only. These are the how-to questions. You're calling in and you have some kind of information you need. That means the remaining 77% are all what we would call agentic issues. These are issues that require issuing a refund, executing a business policy, taking some complex decision, or taking some complex action. And that's really where most of the value is being delivered in customer service AI, but it's also the hardest part for AI vendors to get right. And so with LLMs, the approach you described of RAG, or retrieval augmented generation, of taking AI, taking LLMs, wrapping it around and applying it to your knowledge base, you're really only going after that 23% or that sliver of issues. And we've seen that time and time again, companies thinking, hey, we're just going to launch an LLM, we'll try something. It's very quick to get to that demo quality or prototype quality code, but to get to that real 70, 80% of impact, you need something greater, you need something better. And I think we're now starting to see with Gartner and other reports here why this is starting to come to roost. We've seen companies like Klarna, when they launched and said they were going to replace all their employees with AI, and now they're kind of backtracking. So a lot of big companies are really just trying to figure this out, and they're learning the hard way that it takes amazing AI and amazing talent still today in order to build true agentic AI that can solve problems for your businesses.
All right, Deon, got to leave it there. It's still an exciting time, and we know anytime you see these sort of new industries come up and these big booms, there's always sort of a divide. A lot of the folks who are doing great things like yourself and other folks maybe who are just trying to ride the wave. Deon Nicholas is the president and co-founder of Forethought Technologies. All right, stick with us. When we return, we're going to set you up for what to watch for the next 24 hours. This is Bloomberg. Here's what markets are going to have their eyes on over the next 24 hours. A big jobs report, the June monthly payrolls data out of the U.S. government, 8:30 a.m. out of Washington. We're also going to get an update on the trade balance and those weekly jobless claims numbers. At 10 a.m., we get more economic data, factory orders, durable goods, and ISM services. And at 11 a.m., Fed speak. Fed President Raphael Bostic, no relation, expected to give his thoughts on the economy and potentially on rates. And just a reminder that tomorrow is the day before the July 4th holiday, so U.S. equity markets will be closing early at 1 p.m. Eastern Time. The Treasury market will continue to trade until 2 p.m. Eastern Time. And of course, on Friday, July 4th, all of U.S. financial markets will be shut down. We hope you join us here on The Close tomorrow. And a programming reminder that because of the early close of trading, the close will start at 12 p.m. Eastern. We hope that you can join us tomorrow at that time. In the meanwhile, stick around. Balance of Power and all your politics news is up next on Bloomberg.